A lot of people have seen this playing out now for around about 12 months. Are they starting to look at it and say, you know what, it's time to play the rest of the world card again?
Yeah, so it's interesting. So U.S. markets have obviously led the way. Where we're seeing interest in playing the catch-up trade, not in Europe, but in emerging markets, in particular China, which might sound, weird given that we just spent, a whole segment talking about Chinese data disappointing.
Yep.
But I think it's the fact that it's already priced in, right? FXI, if you look at the Chinese ETF, down 22% since last January. It's still, I think, 8% below the highs that we saw in May. A lot of the bad news have been priced in, and what we're seeing in terms of customer activity is people positioning for upside using options in FXI.
Michael, what's your
There's
view
still
right
a lot
now?
of flows into EM debt, and that's where we're taking a larger position. Right? We still maintain equity exposure in the EM space, but EM debt, dollar denominated, has been a great trade. It should likely persist because of your excess yield, even though there is duration risk. That may be a better part of the portfolio to take it. Within the equity side of the component, that has lagged for quite some time, and that's starting to really a little bit of flows into that space. But I would say it's on the debt side where local currency is starting to become a little bit of a foreshadowing to what could theoretically go into the equity market.
Jim Caron?
The absolute upside risk is what Mandy's talking about. If you do get a recovery in China, you'll get an inventory rebuild, and you'll have a second half of the year where the fourth quarter GDP in the U.S. will be super strong, and we're not priced for that. Not at all. So I think that China is in a precarious situation to the extent that if they do dip below 6% growth, I think things start to get worse very quickly. They are doing everything they can to make that not happen, so they're throwing everything at it. So we'll see if they're successful, but that's what we have to keep our eye on.
What's your conviction call right now, if you've got one?
It's emerging markets, without a doubt. And the reason why is that developed market central banks are cutting interest rates. This gives emerging market central banks the opportunity to also cut interest rates without risking a deleterious move in their currency devaluation and inflation. So therefore, you're looking at central banks in emerging markets that have very high rates that can cut, and the bond markets are going to do very well in that environment.